Hey guys, Akil Stokes here. Welcome back to another episode of the Trading Coach Podcast. Today, we're going to be talking about one of the deadly sins of trading, which is overtrading, and why yours truly actually may be partially responsible for why you are doing so. And yeah, we're going to get into that. I'm also going to share with you something really shocking, and that is how little experienced traders actually trade. I'm talking little by frequency, not necessarily by size, but size-wise, we tend to trade little as well. Now, we are on video today, so YouTube audience, I know you saw the video that I put out earlier in the week where we were breaking down some charts that were stuck in the muck, meaning they were in consolidation, they were going sideways, doing the wounded crab. And if you remember, there were two main trading opportunities that we looked at. There was one that we actually found a potential opportunity. It never actually happened. The market went the other way, so we had to erase all of our notes. And then the other where, well, we tried our darndest to break down everything, and at the end of the day, nothing was there. Now, what I didn't show you was after the analysis in my live trading room, we had a pretty good conversation about overtrading and forcing trades and reassuring our traders that, hey, it's okay to break down the charts and find nothing. We don't have to find a trading opportunity every single time. And the more I thought about it, the more I wanted to share it with you guys because, well, that's the point of this podcast, to share the things that are important in trading with you guys so you can know those things and have a better chance at actually making it as a trader. Now, back to me being partially at fault for this. So, the other day, I put out a podcast episode, it was a video episode as well, called The Mindset Shift That Changed My Trading Forever, where we talked about how, as a trader, we need confidence in order to survive the markets. And I did share with you some techniques in that episode about things that I learned from Tony Robbins, and one of them was encouraging you to stand in front of a mirror and yell at the top of your lungs, "I am trader." Now, in hindsight, as I think about it a little more, you maybe don't want to scream that at the top of your lungs. There's a lot of war going on, and depending on where you're at, if you yell out that you're a trader, that may be looked at in a different way, and there may be much worse consequences than you losing money in the market. So say it with confidence, but maybe check your surroundings first. Regardless, the point is we need to embrace our identity as a trader. Now, although I fully stand behind that statement as it was a massive turning point in my trading career, it's also a double-edged sword. And the problem that comes with identifying as a trader is kind of one of those self-fulfilling prophecy type of things, right? When we identify ourselves as a trader, we convince ourselves that being a trader is not what we do, but it is who we are. And if being a trader is who we are, then if we aren't always trading, who are we? Pretty much from a non-philosophical perspective, we feel like we have to trade in order to have that label as a trader. In a way, it's kind of very similar to being like a kid on Christmas, where it's Christmas, we are getting all these toys, and in the trading world, our toys are like knowledge and tactics and strategy, right? And naturally, we want to play with them, and it doesn't make sense not to have all these beautiful trading Christmas gifts and not being able to play with it. However, unlike gifts at Christmas time, in trading, there's a problem that comes with that, and that is going to be risk. Whenever we involve ourselves in a trade, we are taking on risk. And if we take on too many unnecessary risks, well, that is the fastest path to blowing your account. Now, speaking of blowing your account, one of the main reasons that traders blow their accounts is because of this lack of patience or impatience. And this just came across my feed the other day. I guess it's a new book by Stephen Burns, who's a good friend of mine and someone we've mentioned on the podcast before. In fact, he's the only person I've ever interviewed for this podcast, which should tell you nice things about him and how important he is to me. But it looks like he has a new book called A Trader's Guide to Mastering Your Emotions. And I haven't read this book, but I do want to read a section that he shared on it. And full disclosure, this is my first time reading it, so I love doing that. That way you get my natural response. But I just know it's good because it's Steve Burns. Now, this is going to be from chapter 13 in his book called Impatience, The Cost of Not Waiting. Starts off with a quote. It says, "In trading, impatience is expensive tuition paid to the market for lessons you could have learned for free by simply waiting." That is brilliant. It's 10:47 a.m. and you've been watching the same chart for 37 minutes. The stock just sits there 3 cents below your planned entry point, a clean breakout level you identified yesterday after your chart analysis. Your finger hovers over the buy button as price teases the resistance line, touching it briefly before pulling back and then approaching again. Each time it gets close, your heart rate increases slightly and frustration builds in your chest each time it pulls back. Man, if this ain't hitting home, I don't know what is. You should wait for the actual breakout with volume confirmation, just like your trading plan specifies, but watching paint dry while the market is open feels like wasting a precious opportunity. What if it never quite hits your entry but runs away? What if you missed the entire move waiting for a perfect setup that never comes? By 11:15, your patience has evaporated. The stock is still 2 cents below your entry, but you've convinced yourself, it's close enough. You buy at the current price, telling yourself those 2 cents don't matter. Within 20 minutes, the stock has dropped 2%, leaving you out for a loss on a trade that never actually triggered your original setup. Impatience at work is the burning need to take action that transforms potentially profitable setups into actual losses, turns disciplined traders into impulsive gamblers, and costs more money than almost any other trading emotion. The deceptive nature of trading impatience. Impatience is unique among trading emotions because it masquerades as a positive trait while systematically undermining the qualities that create trading success. In most areas of life, impatience might be seen as drive, urgency, or unwillingness to accept mediocrity. In trading, however, impatience is one of the most expensive emotions you can experience, consistently leading to poor entries, premature exits, and abandonment of proven strategies. The fundamental problem with trading impatience is that it feels like taking control and being proactive when surrendering control to emotional impulses rather than analytical reasoning. When you're sitting in front of your charts waiting for setups to develop, impatience whispers that you're being passive and unproductive. See, I told you those two little demons that stand on your shoulder are real. I joked about them a lot. That's just impatience. See, I'm not the only one. It suggests that successful traders act while unsuccessful ones sit on the sideline waiting for perfect conditions. However, successful trading often requires precisely the opposite of what impatience demands. The best opportunities frequently require patience to develop correctly. The highest probability setups often involve waiting for specific confirmation criteria, and the most profitable trades usually come to those who resist the urge to force action when conditions aren't optimal. The time distortion accompanying impatience makes waiting feel much longer and more wasteful than it actually is. Minutes feel like hours when you're watching a setup develop, creating pressure to act immediately rather than wait for optimal conditions. Impatience also creates a false sense of urgency around market opportunities, making every potential setup feel like it might be the last good opportunity for days or weeks. The activity bias that drives impatience makes taking action feel inherently valuable, regardless of the quality of that action. When you're impatient, doing something, anything, feels better than doing nothing, even when doing nothing is the optimal strategy. This bias is particularly problematic in trading because the highest quality opportunities often require periods of apparent inactivity while setups develop and conditions align. The psychology of market timing and urgency. Trading environments create unique psychological pressures that amplify natural human impatience in ways that can devastate performance. The human brain evolved in environments where immediate action often meant the difference between survival and death. When our ancestors saw a potential food source or detected a possible threat, hesitation could be fatal. This evolutionary heritage creates intense psychological pressure to act quickly when opportunities appear, even in the modern context where patience would produce better outcomes. The intermittent reinforcement schedule that markets provide creates powerful psychological addiction to immediate action. Unlike predictable rewards that quickly lose their motivational power, trading offers variable rewards on unpredictable schedules, exactly the pattern that creates the most compelling behavioral conditioning. Your brain becomes trained to expect potential rewards from trading activity, making periods of inactivity feel like missed opportunities, even when patience would improve your results. The opportunity cost anxiety that accompanies trading impatience makes waiting feel economically wasteful. When you're sitting in cash waiting for proper setups while markets are moving and other traders are active, you believe impatience costs you all the money you could be making if you were taking action. This anxiety is amplified by the fact that you can observe potential profits in real time, watching stocks move in directions that would have been profitable if you would have taken positions earlier. Trading communities and social media that celebrate activity and quick decision making while rarely acknowledging the value of patient waiting intensify the social pressure aspect of trading impatience. When you see other traders posting about their active positions and their quick profits while you're waiting for setups, impatience makes your disciplined approach feel inadequate and unproductive. The control illusion that impatience creates makes taking action feel like controlling outcomes when it's actually surrendering control to emotional impulses. So yeah, that long blurb was from a book called A Trader's Guide to Mastering Your Emotions by Steve and Holly Burns. Again, I haven't read it yet, but after just reading those few pages, I'm going to head on Amazon right after I'm done recording this, and I'm going to add it to the collection over here. All right, now, where were we in the story? So later on in that live session, right, somebody asked me a little bit about my daily routine and actually how much time do I spend on the charts each day. And I'm not going to go through my entire routine today because it's entirely too long, but I will link at the end of this video and probably in the show notes below, links to Trading Coach Podcast episode 185 and 1019 if you want to see both my full old and new trading routines. But to summarize it, or maybe not summarize it, just to talk about it, I spend a lot less time on the charts than what you probably think. And after explaining this to the room, I thought it would be a fun exercise to actually figure out what percentage of my analysis, so time spent on charts, actually results in a trading opportunity. But before I share my number with you, I asked you guys the same thing on our YouTube community, and here's what you said. 11% of you said that over 75% of your analysis results in a trading opportunity, meaning a trade that you actually take. 5% of you said that 50 to 75% of your analysis results in a trade. 32% of you said that 25 to 50% of your analysis results in a trade. And a whopping 53% of you said that less than 25% of the time that you do analysis, it results in a trading opportunity. Now, let's look at mine. So, where does yours truly lay in this equation? Let's check it out. Now, for this example, we're only going to count analysis done on assets that I can actually trade. So my personal trading portfolio consists of 9 pairs. It consists of the euro dollar, the pound dollar, the euro yen, the pound yen, the dollar yen, dollar Canada, Aussie dollar, New Zealand dollar, and Aussie Canada. And even though I analyze a lot more than that on the regular basis, right, in the live room, we'll go over things like gold and the DAX and whatever people want to take a look at. I'm only going to count these 9 pairs because they're part of my actual trading portfolio, meaning that those are the only pairs that I can actually execute live trades on. And before everyone jumps in the comments, right? No, I'm not saying that these are the best pairs. I'm not saying that you need to trade these pairs. They are simply the best pairs for me, or the best blend of pairs for me personally, and my goals and what I want to achieve from the markets. So let's hop in. On average, I perform about 3 major rounds of technical analysis per day. I have my morning prep period, which is usually around 6 a.m. in the market. I do my live room analysis, which is during the New York Open session. Then I do an evening analysis at some point in the evening, depending on which kid had soccer practice and how late we get home and how hungry they are and all the things that come with having kids. Luckily, that's a low liquidity time in the market, so it's really just prep for the overnight. Now, obviously, if I already have a trading idea on the radar, I am monitoring it throughout the day, but that's more of a trade management type of scenario versus analysis, so we're not going to count any time that I spend looking at the charts midday. So let's just say I do 3 rounds of analysis each day, except on Fridays where there's no evening sessions because the markets are closed. That's going to give me, math time, 14 rounds of analysis, per week, right? Now, since I analyze 9 pairs each time I perform these 3 rounds of analysis, that means I'm looking at the charts roughly 126 times per week. You multiply that across 4 weeks in a year, that's going to give me 504 rounds of analysis per month. I like doing math because it keeps me sharp, and I hope these numbers are correct. If not, you get the gist of things, right? Anyway, here's the shocking part. Out of those 504 analyses charting, I only take about 15 trades per month. That's crazy, right? Now, that number did used to be a lot higher back when I was actively day trading, and that stopped in 2020, right during the COVID. But over time, just in general, as I've become more experienced as a trader and more comfortable with my personal style of trading and the trades that I like, I've honestly become more selective in the market. I take less opportunities, but I only take what I consider to be grade A opportunities. And add to that, just being more experienced and more disciplined, I also make fewer mistakes. So there's no more emotional trades, like the FOMO trades are gone, the revenge trades are gone. I am literally not forcing anything and only taking what I consider to be the best trades. Now, back to that number, right? 15 trades, 504 charty stuff. If I divide that 15, the trades, by the number of analyses that I perform, 504, that means that I only get involved in trades about 3% of the time that I mark up charts. And no, I didn't do that in my head. I knew that from the live session earlier in the week. Just don't want to be a fraud here. And to be honest, when we first did that calculation, I had to do it a few times because I didn't believe it, right? 3%, that is a tiny, tiny, tiny bit. But as I thought about it, and as I thought about many of the conversations I've had with different veteran traders in the industry, they'll tell you the same thing. And that is that new traders, even them as a newer trader, they were more inclined to look for action. And as an experienced trader, you tend to look for quality. Now, real quick, speaking of analysis, if you are going to be spending a lot of time on the charts, it's important to have the right machine to do it. I get questions all the time about trading computers, what to buy, what specs matter, whether I should build one myself. And honestly, I know nothing about that stuff. But I do know someone who does, and that is my good buddy, Eddie Z. He was also a trader as well. So I love it when traders are actually talking to you about things that traders need. Anyway, after getting tired of me constantly forwarding your computer questions to him, he decided to simplify things and just build me a free trading computer builder's and buyer's guide. So seriously, it's an awesome resource that breaks down what is a confusing process for many into something that's very easy to understand. And I can personally vouch for it because Eddie built both of my trading computers. And yes, if you're doing the math, I've been trading for nearly 2 decades and I've only had 2 computers. So yeah, these things last forever. So scan the code on your screen, download that guide, and please stop sending me emails about trading computer specs because I genuinely have no clue what I'm talking about there. Now, back to the topic. Before I wrap things up, I want to make this very clear. Just because my trading frequency is low doesn't mean that that's the correct number. Remember that I've designed my trading around the lifestyle that I want, right? And it's not because I don't love trading, I absolutely do, but it's because my ultimate goal has always been to achieve time freedom. That freedom has allowed me to coach track and field for my entire career. It has allowed me to mentor thousands of traders. And most importantly, it has allowed me to be very present as both a husband and a father. There are many other paths that I certainly could have taken, but being the selfish, stubborn person that I am, and this is why I wanted to do trading in the first place, I wanted to map out the ideal path for me. And I think that's the coolest thing about the profession of trading. Anyway, before I leave you, here's the thing about overtrading, because I get asked a lot of questions about how do I know if I'm overtrading. Remember this, overtrading has less to do with the number of trades that you take and more to do with the percentage of good trades versus bad trades that you take. And oh man, I've got a hell of a podcast episode, audio only, coming your way shortly about a great conversation about good versus bad and all that fun stuff. So watch this space for that. But back to the overtrading, think about it like this. If you take 100 trades a day, your broker will love you. But if you follow all of your rules on every single one of those trades, that's not overtrading. On the contrary, if you take 2 trades a day and one of those trades doesn't meet your rules, that is overtrading. So you can see it's all relative. Hope you guys enjoyed the pod. Show me love. Hit that like button, rate, review, follow all the stuff you're supposed to do. And do me a favor. I would love to see what your calculations are. So do the same calculation that I did about like analysis time and charts and trade execution, and share your number in the comment section below. I know many of you guys answered the YouTube poll and it gave us some wide ranges, but I would love to see that specific number. And I'm curious if I'm all by myself in that 3% range or if more of you are down there as well. So it's a fun activity. I think it gives you cool insight about kind of your trading, and it helps you realize that, man, I don't need to trade all the time. And I'm also just curious on what your number is. All right, until next time, plan your trade, trade your plan. Take care.